Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist at Morgan Stanley. Mike, great to have you with us.
Thanks.
You basically say people are all hung up on inflation, what the Fed is going to do, but it's time to focus on growth or the lack thereof. It seems to me that sort of intersects, that we're taking a look at a Fed that's inclined to raise rates. Maybe its hand is being forced, but it's got to do that in the face of decelerating growth.
That's exactly right. So, I mean, look, I think I guess 6 months ago, we were very focused on the Fed. I think the bond market, some of the bond investors were focused on, the Fed was behind the curve. It was kind of obvious they were going to shift coming out of that August Jackson Hole meeting. So we call that the fire part of our narrative. And I think equity investors just didn't think it would matter. But of course, it did matter, and it mattered gravely for the very expensive parts of the market. And that now has adjusted, and that's good. That's part of our call for this year, is that the derating process was going to be most severe for that, most expensive part. I still think the derating process is incomplete. The question now, though, is can earnings growth, revisions, as Jim puts it, can that offset another 10% plus derating at the S&P level? And our view is that, we don't think that's going to be the case. We think now we shift our focus towards the slowdown that was already in place, and the Fed now is tightening more than even we expected going into that. And that should lead to further deceleration. So there won't be enough revisions to offset that derating. So that's where we are. We're just kind of stuck. It's not the end of the world, but we got to get through that. And I think the risk on those earnings revisions is the greatest in the first half of this year, first quarter, second quarter, because that's when the pent-up demand is fading the most. The comparisons are most difficult. And we're starting to see some supply pick up now in areas which could actually lead to some deflationary whiffs of deflation in certain areas where there's going to be pricing power, right, where there was not enough discounting over last year. And that all has to play out. So it's going to be messy for the next, I would say, 4 to 6 months.
How do you invest in that sort of environment? And I'm thinking about the idea, the notion that there's not going to be much growth. And the playbook of investors in the past has been to go to technology when there isn't cyclical growth in the economy. But that is the precise sector that is getting derated, if you will, in this volatility.
It's exactly the right question, Melissa. I mean, normally I would say go right back to the FANGs, go right back to the secular growth. The problem is a lot of the secular growth stocks, never experienced the recession because there was a pull forward in demand. So that's the difference this time. That's why we're seeing some of these fallen angels in the forward favor group. And I think that's the way you got to look at it. We're looking at, we call this the year of the stock picker, because even within groups, there are going to be stocks that don't make it because they can't execute, and there are going to be ones that do execute and make it. And so it's really about stock picking, and that's what it's going to come down to. So this idea that it's tech versus banks or energy, I think that's out the door. I don't even like the value versus growth so much. It's what stocks do I want to own within each sector? And it's going to come down to who can execute in a very difficult operating environment, deliver the revenue growth either through unit growth or pricing power, and hold on to that margin. So that's the game. It's just getting hard. It's been harder. We're in a bear market for stocks. We've been in one for 6 months. Anybody can see it. The index is held up. Our view is that the index will eventually catch down. That could be wrong. That's our view. We'll see how it plays out. Right now, we're just trying to pick stocks within groups.